In the world of trading, finding a profitable trading strategy is only half the battle. Our own minds, with their inherent trading biases and cognitive errors, often become the biggest obstacle for making money. From confirmation bias to the anchoring effect, these hidden trading biases can erode your profits. A trading bias works like a saboteur from within. In this video, we'll unveil the most common trading biases and cognitive traps that can derail your strategies and lead to costly and unnecessary mistakes. We'll also show you some easy tips on how to minimize them. By understanding and overcoming mental roadblocks, you'll make rational and unbiased trading decisions. First, let's briefly explain what a trading bias is. A trading bias is a cognitive error or behavioral mistake which limits clear and rational thinking. Most of the time, these are systematic and not occasional errors, even repeated on a daily basis. When a trader is biased, it limits rational decision-making because feelings and emotions intervene. The famous writer Morgan Housel once said that investing is not the study of finance, but the study of how people behave with money. Knowing your trading biases is essential to understanding your limits, possibilities, and how to improve your trading. Furthermore, the more you understand trading biases, the better you understand the market. Let's look at some of the most common trading biases. The first one is the optimism and pessimism bias. It's the failure to think long-term and instead let short-term noise overrule rational judgment. For example, if you've done well, you might feel great and optimistic. As a result, you increase the position size. Opposite, if you've performed poorly, you're pessimistic and reduce the position size. This roller coaster influences your trading. Being pessimistic can even make you stop trading or tinkering with your systems at the exact wrong time. Furthermore, many have an all-or-nothing approach. If you fall short of your expectations, you increase positions to make back lost money. Another common trading bias is anchoring. We anchor the share price and wait for the stock to drop down to a previous level. That might never come. We wait for a stock to drop down to 100 because it traded at that level 1 year ago, only to stay on the sidelines as the stock continues up. Unfortunately, the market has no memory, so it won't care about your buy or cost price. Perhaps the most common trading bias is loss aversion. We react more negatively to a loss than positively to a similar gain. Consider the difference between earning $100,000 annually for 5 consecutive years versus making a one-time gain of $500,000 in the first year, followed by 4 years of no returns. While the latter lump sum may seem more impressive, the consistent incremental gains of the first scenario provide a more fulfilling and enduring sense of accomplishment. The steady flow of smaller victories fuels motivation. It allows for gradual improvement, adaptation, and development. In contrast, the single large gain can lead to utter misery. You'll have 1 great year and 4 miserable years. Thus, the frequency and sequence of returns matter because we react more negatively to a loss than a corresponding gain. Another common trading bias is confirmation bias. We stick to information that confirms our beliefs. This is the wrong approach, obviously. You might reject a seasonal trading strategy because you don't like them, even when there's an abundance of information that supports them. As such, you ignore or dismiss info that contradicts your view. Charlie Munger once said that if you don't change 180 degrees on something important every year, you're not thinking hard enough. Another strong trading bias is the fear of missing out, abbreviated FOMO, and also called the bandwagon effect. When traders are making money on rising prices, you feel uneasy when other people are sharing screenshots of profits while you're missing out. This is magnified by social media. In the end, you can't resist anymore and you buy only to see the price reverse and head south. And what about the hindsight bias? Everything looks easy in hindsight. You knew it all along, but we tend to forget it wasn't so evident before it happened. How do you deal with hindsight bias? We recommend writing down your reasoning in your trading journal before you make a decision. You'll be surprised that most things are not as evident as it seems in hindsight. One of the costliest trading biases is to be fooled by survivorship bias, also quite similar to selection bias. We form conclusions on incomplete information. Let's give you an example. You might want to backtest a momentum strategy for the stocks in the S&P 500, and you start by downloading the data of the stocks that's in the index today. But unfortunately, over the years, hundreds of stocks have been delisted from the index, and most of them have performed poorly. You're thus backtesting the winners and survivors, and you ignore the losers. Your backtest is likely to be a lot better than in reality. One of the oldest known trading biases is the erroneous belief that if a particular event occurs more frequently than normal during the past, it's less likely to happen in the future. This is the gambler's fallacy. As a trader, you need to think in probabilities. Lastly, traders tend to be occupied with the present, something called status quo bias. But what works today often doesn't work tomorrow. Most strategies stop working sooner or later. You better prepare for tomorrow. Trading requires constant research for new strategies and styles. How can you overcome any or most of the trading biases? In medicine, you can take pills to relieve pain, but the pills only treat the symptoms, not the cause. In trading, you don't have a painkiller. You have to go to the root of the problem and look at the cause. Once you understand how your behavior influences your trading, you can overcome or minimize them to increase your profits. Just by being aware of your trading biases is a great start because you're unlikely to eliminate them, only limit them. Almost all trading biases come from no detachment to money. Anyone can be successful trading a demo account, but demo trading never resembles real trading with real money. You have no skin in the game. The best advice to reduce trading biases is to trade small. By trading small, you get detachment from money. Another advice is to do algorithmic trading. The computer creates a layer between you and your trading. The computer doesn't think and is not susceptible to emotions. A computer only does what it's told. A third way to reduce trading biases and mistakes is to implement checklists. Checklists have reduced human errors in airplanes, and they're guaranteed to reduce unnecessary mistakes in trading. Last, we recommend reading about human biases and cognitive errors to better understand them. We've covered many trading biases on our website, quantifiedstrategies.com, but we also recommend reading Rolf DeBelly's book called How to Think Clearly. This is an easy read about the 99 most common cognitive errors humans make. If you like this video, please like, subscribe, and comment to help us provide more free videos like this.